Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by Austral Asset Management. It's the 1st of March. We've got the new month. And we have today Craig Erlam, Senior Market Analyst at Oanda, as our guest today coming out of the UK. Craig, it's always great to have you on the show.
It's always great to join.
Now, Craig, before we get your insights, let's take a look at how markets across the region have performed, particularly crypto markets as well, which we will lead with. Bitcoin is at 23,786. It's up 1.59%. Ethereum is at 1,657. It's up 1.84%. Now, looking across the regional equity markets, we start with Singapore. It's SGX is up 0.11%. Bursa Malaysia, the KLSE bucks the trend. It's down 0.34%. Shanghai is up 1.01%. The ASX All Ordinaries is up 0.1%. The Nikkei is up 0.23%. The Hang Seng is up a whopping 3.61%. And rounding up the numbers, we've got the Kospi, which is up 0.42%. Craig, there's a big anomaly there with the Hang Seng. Tell us why and give us your comments on regional market performance.
Well, I think you just have to look to how close the ties ultimately with China and how closely correlated it is, whether that is the country itself, whether Hong Kong actually being so reliant on inbound tourism from China, or just the fact that it houses so many massive Chinese names and stocks, which is meant that it's had quite a bruising performance, should we say, for quite some time now. And those PMIs that we saw from China overnight really has driven some optimism in the region that not only is China successfully transitioning from zero COVID to living with it, but that it's starting to thrive once more. And all of a sudden, people's growth expectations for the second quarter are going to look much more rosy. Now, it is still going to be a jittery year. There is still going to be the global economy is still going to have a weighing effect on the Chinese demand or on demand for Chinese goods. But this is a really, really promising early sign that the transition is running smoothly, and that's going to benefit not just China, but it's going to benefit those places where Chinese stocks are listed, like Hong Kong. But it's also going to benefit the region as well, because if we're seeing this successful transition, that means more demand and it means more travel. And that's so important for the region.
Okay, now, Craig, I want to get your insights more from a macro view. What is your view overall on price action in global bond and equity markets?
So the last week or so has been relatively quiet, but we're talking about two different stories really with bond and equity markets. You've got bond markets, which have been very reactive to the data. The data from the US in particular in January was quite disappointing. And by disappointing, I mean, it was just too good. We don't normally say that with a negative, but unfortunately, at this point in time when inflation is running so hot and the labor market is so tight, it's not really what we want to see right now. We don't want to see something that incentivizes the Federal Reserve and other central banks to keep raising rates when they're already at such high levels. And in January, we had a red hot labor market report with more than 500,000 jobs added. We had a retail sales figure of 3%, which was much higher than expected, showing strong consumer confidence, strong household spending still. And we also had an inflation number, which while it came down, it was extremely stubborn. The good thing is, each of those numbers are going to be released again for February before the next Fed meeting. So we could see those expectations pared back. But at this moment in time, markets have shifted from pricing in one more rate hike this year and maybe a couple of rate cuts later in the year to 3 rate hikes this year and no rate cuts. That's such a dramatic shift. So you would expect that would have had a bigger impact on equity markets and wobbled sentiment a bit. But it just hasn't really. It's stalled the equity market recovery, but we haven't really seen that much of a corrective move. Shows what different pages equity investors are on from bond investors. Perhaps equity investors are looking at this and saying that this looks like a blip in the data. We know that unseasonably warm weather has driven a lot of this economic movements, economic data, that we've seen in January. So maybe there's a kind of a bet on that being the case and the February data correcting itself and giving the Fed those little bit of assurances ahead of the next meeting, or at least ahead of the couple after that, that we could start to see signs of cooling once more. But like I say, we're seeing two different narratives play out in the bond and equity markets right now, and it'll be interesting to see how quickly that corrects itself.
Now, from broader equities, then to commodities. What's your outlook on oil and also gold for the coming weeks ahead?
So there's so many narratives for oil that drives those markets, and at this point in time, it seems to be two things primarily. One is China, which we've just discussed, so that's going to be a big upside risk for gold for oil, and the other is the state of the global economy, which is so closely linked to interest rates. And those two things have kind of been offsetting each other a lot over the last month or 6 weeks, and we've therefore seen a lot more consolidation in the oil markets. Now we're talking wide consolidation, very much to the analogy, moving like a bit of an oil tanker, really, slowly drifting between support and resistance. But we're not really seeing a breakout in either direction. We're not seeing massive moves to the upside or to the downside. The thing that's going to change that is going to be one of two things. One was obviously China, and we've seen some really positive data here. If we can see more data to back that up, that's going to be a massive bullish factor for all markets. And the other is going to be the global economy, and if we can see some better data showing more cooling in the economy, which means central banks need to ultimately do less, which becomes less of an economic risk further down the road for these economies, and therefore less demand. So therefore, from my perspective at least, that means that it's more tilted towards the bullish side. I think the outcomes over the next month or two could be more bullish factors potentially for gold, because I do think the upside risks for this the US economic data in particular is more likely than the downside risks in terms of showing more cooling. And I think China, the ability to bounce back strongly, as we've seen from these PMIs, is also clearly evident. But there's so much uncertainty in these markets. I don't think you can ever say anything with too much conviction at this point in time, because things can always swing entirely in the opposite direction, as we've seen over the last month. As far as gold is concerned, it's so closely linked intrinsically to US interest rates, and the fact that we've seen those pushing higher and those expectations pushing higher means that gold has drifted back towards $1,800. The good thing is $1,800, I think, is a big support level potentially for gold. 1780 through 1800 looks like a really interesting area of potential support. We're seeing momentum start to dry up on that decline as well. So ultimately, we're going to be data dependent, but we are seeing some signs of that rally, of that decline slowing.
Now, Craig, then final question. It's around cryptocurrencies. What's your view on the price action, particularly the fact that cryptocurrencies have run up so much this year?
They really have. It's been a quite remarkable start to the year. 50% gains from lows to highs since the start of January. I mean, it's been quite a phenomenal run, and multiple a few different factors at play. One has been the risk sentiment in the markets, and we've very much seen a resilience in cryptos that we've also seen in equity markets. I think there was a catch up aspect as well. The FTX shock meant that towards the back end of the year, while equity markets were rallying, we weren't seeing the same thing in cryptos. And I think there's been a bit of catch up there when we haven't seen the negative contagion effects that we could have potentially seen. It could have been far more severe. We haven't seen that. So I think we've seen a bit of a catch up from that perspective as well. But now we're at a point where the key levels are appearing once more. 24,500 through 25,500, such a significant area of support and resistance on the way down, and I think it's going to be really interesting on the way up as well. And that's where this recovery rally has stalled. The question is, are we going to see that continued resistance in cryptos, which is going to be, I think, closely linked to what we see from interest rates and economic data? Or, I mean, we could see some news flow that affects that as well. Or are we going to see a bit of a corrective move because, as we've just alluded to, we've seen such a staggering recovery rally since the start of the year? You would think typically that could inspire maybe a bit of profit taking or a bit of a corrective move, but we haven't seen it so far to any significant degree in cryptos. It seems that enthusiasm has returned in force.
Now, Craig, as always, thank you very much for your insights. Thanks for coming on the show.
Thanks a lot.
Now, I'm Brian Fernandez, and we've been speaking to Craig Erlam, Senior Market Analyst at Oanda on BizStack's Asian Midday Market Watch, powered by Austral Asset Management. This show will be on our website, www.bizstack.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.